Good morning, folks. Hope everyone's had a good start to their trading week. Happy Taco Tuesday to those who celebrate this momentous day. Certainly looks like the futures market's a bit lively this morning. Got a little bit of a bid in the NASDAQ, S&P both up. Let's see, NASDAQ up 0.4%, S&P up about 0.25%, Dow Jones up 0.2%. And we're just getting everything started here, so stay tuned. Should be a pretty fun session. All right, so first and foremost, let's talk a little bit about risk. I always give the risk sermon, as I like to call it, when I'm live. And the reason I like to talk about this is because this is one of the biggest areas where people struggle and often sadly fail. Risk management is the most important part of your trading journey by far. One of the rules of thumb that I like to use is not putting too much of the account at risk. 1 to 2% of capital at risk is really a reasonable limit to consider, because that way you always have capital to go back to and continue trading. Now, obviously, that might not work for everyone, especially folks that have smaller accounts. There might be some nuance required there, but that's how I like to approach the markets, because at the end of the day, you're not going to get emotional about your trading if you're not putting an enormous amount of capital at work. And if you're not getting emotional about your trading, then you're more likely to do well over time. The other thing that I think is important is journaling. I think everyone should keep a trade journal. I know it's not the most exciting part of a trader's journey to journal everything that you do, but that's the work part of it. That's the part where the rubber meets the road in terms of being able to build consistency over time. You've got to take this stuff seriously. If you really do want to make money in trading, or, over the long run, make a living in trading, you've got to take it seriously. You've got to run it like it is a business, because ultimately what you're doing is buying and selling inventory and capturing a positive spread as often as you can. With that in mind, that's the fundamental principle. Run it like a business. If you aren't running your trading like a business and you're running it more like a sort of just winging it, hoping for the best, that can definitely lead to problems. Let's talk a little bit about my journey in trading. It's been about 20 years. Started in 2005, trading stocks, then getting more into options, futures, commodities, and Forex. Really, I'm a multi-strategy, multi-time frame trader. And what that means is I'm going to trade momentum where it is. I'm going to ride relative weakness. I'm going to ride relative strength. I'm going to fade relative weakness. That's really the two parts of how I like to trade. I like to find momentum that's moving higher. I like to take advantage of that on multiple time frames, whether it's day trading or swing trading. Like for day trades, I prefer trend days strongly. It's not that it's not fun to play ping pong with the market when it's in a consolidation phase. I just tend to do better when it's more of a trend day. It comports with my trading style and my psychology. That doesn't mean that everyone needs to trade the same way. In fact, I would take the opposite side of that and say it's best to figure out what works best for you. For me, however, momentum has been a really important part of my strategy because you can qualify momentum. And so what that means is you can actually determine with backtesting and systematic analysis where these turning points exist in various instruments. You take a set of data during an uptrend, and when it's ended, you take several of those sets, you analyze them, backtest them, and you can start to see where these turning points exist. That's actually really helpful because one of the problems that folks get into in trading is overthinking, guessing, letting emotions take the driver's seat in execution, and then getting hurt. And if you think about it, it actually makes a lot of sense. There's no real occupation where you're going to let emotions take the driver's seat and you're going to do well over long periods of time. Trading is also not one of those. In fact, I would say trading is a journey into your psyche. You're going to learn all about your demons. You're going to learn all about the things that, basically poke your ego, make you feel insecure, make you angry, make you greedy, make you fearful. You're going to pay a tuition to the school we call the market. A lot of that will be from those emotions. And it'll be up to you to choose whether or not you're going to learn the lessons that are being taught. I mean, we all pay, right? That every loser and every single trader has losers. That's your tuition to the school of the market. If you're keeping a trading journal, then you can review those winners and losers and you can learn and you can polish your process and build into consistency. If you're not keeping a journal, it's much more like guesswork because you're not necessarily going to recognize the pattern, certainly not while you're in the trade, and then reviewing them later will be a lot foggier without a written record. And that's why I like to say it's important to take this stuff seriously. A lot of the folks that I've seen that have made it over the years, including myself, have treated it much more like it is a business. You get up every day, you make sure you have money in your account for the next day, you trade, you manage your risk first and foremost, and then the other pieces fall into place. You build your process, you continue to iterate and improve it, not while you're in the trade, but while you're reviewing your journal. And eventually, you find what works for you, you find what doesn't work for you, you lean into what works, and you become a better trader. There is an alarmingly poor success rate in trading. About 90% of traders fail. Why do 90% of traders fail? Because they don't put in the work. That's the biggest reason why. Impatience, greed, getting lucky and then blowing oneself up after getting too arrogant about it, that's a huge part of this journey. You've got to reconcile your demons. And I know I'm talking to people that have experienced this themselves, some of whom have climbed over that hump. Others are still struggling with it. Feel free to reach out. Also, check out my video on trading psychology. It's pinned on my YouTube. You can find that at youtube.com/@mayhem4markets. It's pinned at the top. I highly suggest watching it at least once to try to improve your mindset. Because I know that, what's in front of us is what trading's all about. It's the price action, it's the volume profile, it's the flow. But until we have our mindset wired properly, a lot of that needs to fall into the background in that it's all about our mind. It's all about being able to execute. It's all about being able to manage that risk when it goes the wrong way. Now, I have a system where I'll set a stop based on the inherent volatility of an instrument. When it exceeds that, I'm out. I'm not looking back. If the trade ends up working, that's cool. I'll look at that in my journal later, but I'm not looking back and wondering what if. I'm focusing on the next, because the other part of trading that we have to really appreciate is the mental capital part of it. How much mental capital do you put into your trading staring at your screen? How much time is involved with that? Is that the best use of your mental capital and your time? Or does it make more sense to systematize as much as you can for signal generation so that you can get alerts when there's an opportunity, rather than burning yourself out over time, micro-focusing on every little move? Now, obviously, some folks are very talented scalpers. They watch the flow, they get in and out. That's fine. If that's how you enjoy trading and you're discretionary and you're successful and you're consistent, more power to you. But if you find yourself struggling, like a lot of people do, with burnout, with feeling like you're just always attached to the computer, or worse yet, you're finding yourself having trouble sleeping because you've got these positions on that are keeping up with anxiety, it's time to take a step back and reevaluate how you're managing your risk, how much exposure and concentration you have, and why you feel the need to obsess, because that is not going to lead to good places over long durations of time. Yes, the market has unlimited amounts of data to pour into and to examine and to learn about, but you don't have unlimited amounts of time and mental capital. You've got to focus on the signal that works for you. And that's also why I like signal generation. Finding ways to backtest for momentum changes on multiple time frames and using that to help us find trading setups. That's one of the reasons I built a lot of the tools that I've built, to reduce the amount of time that I spend poring over charts and allow algorithms to do a lot of that repetitive work for me. And that's led to a lot less of that feeling of burnout for me. It's also led to me not having to stare at the chart all the time, because often when there's something that I need to see, there's an alert that's generated that draws my attention to it. Let's talk about this week's pivots, and I'm going to share these on social as well. And we are just kind of testing this level on S&P. We're above it on NASDAQ. These are my bullish above, bearish below weekly pivots, and they're generated based off of market information, talking about price action, volume profile, and a couple of other areas, even including consideration for options exposure. So basically, if we're able to climb above these levels and build some acceptance, I would be looking for more longs, continuations both on the intraday time frame and on the swing time frame. And I'm just sharing these on social right now. And folks, if you have questions while I am streaming here, feel free to drop them in the chat. So basically, where we are on the S&P, let's pull up a chart here. We've got some pretty chunky support below, which I think will probably hold. But we've got the EMA 21, that's the 21-day moving average. We've got the Ichimoku cloud, and we've got this area where you can see there's a rebid zone just below, where every time we get back into that area, going back to early October, there's a strong rebid, including recently. One thing, however, that concerns me, you can see below here, the relative volume over a 50-day smooth period. You're seeing a fair amount of selling in there. So there are some desks that are de-risking into this recovery off of just above 6,500. You know, we've risen over 300 points in a short amount of time. Some folks are probably selling into that. The other thing that I would say is a bit of a risk here is the durability of the AI growth narrative. That's something that I think the market is starting to question a little bit more, whether or not all that spend on GPUs as is planned is really realistic and necessary. And we're starting to see some trouble with OpenAI. In fact, apparently, Sam Altman issued a red alert memo. Now, I had talked just before Thanksgiving that several large AI startups were in panic mode. That was something that I was hearing from contacts in the industry. It's also something that you could just see if you're paying attention to some of the things that are going on, like ChatGPT considering ads or downloads at Perplexity dropping, or some of the scrambling that's going on behind the scenes as Google releases Gemini 3 Pro, Anthropic releases Claude Opus 4.5, and you have now DeepSeek 3.2 coming out and starting to lead the benchmarks at a fraction of the cost of its competition. At the end of the day, that competition is a good thing, but it also means that AI models are becoming more and more commoditized. And I don't think that spending plan is going to be realistic. I also don't think LLMs are the future of AI. Nevertheless, this is a market that has been rotating for most of the month of November out of some of those high flyers into safer areas of the market like healthcare, like utilities, like some of the consumer defensives and staple stocks. We'll see if that pattern continues. Yesterday, it was a bit of the opposite, a rotation out of those safe havens back into select parts of tech. And this market, pre-market right now, we're kind of seeing a pretty widely distributed bid. NVIDIA's up 1.3%, Oracle's up 2.1%, Apple, Microsoft about flat, Amazon bid. It looks like a day where the NASDAQ could get a nice juicy start though. So we'll be paying attention to some of that NASDAQ leadership as we get into the trading day. How it's trading tends to set the tone for the entire index, especially those heavyweights. Let's also take a look at gold. I've gotten so many questions about gold. And look, at the end of the day, you do not want a commodity to go straight up. You simply do not want to see that happen. Anytime you see a commodity or something like Bitcoin going parabolically higher, that typically leads to an unwinding. So that's something that I think you just kind of want to take into consideration in the back of your head, that if you see a move like we saw from August to October and it just keeps going and going and going, and there's no pause and there's no consolidation like we've seen, that can lead to a crash. So the fact that we've paused and spent really the better part of 2 months consolidating is a good thing for gold. That's what you want to see, just like this long period of consolidation that happened over spring into summer. That usually sets up for a continuation. I like to look at consolidations within a healthy trend as a spring that's coiling up. The longer the time is spent consolidating, the more energy that's pent up in that spring. When it ultimately releases, more often than not, of course not always, but more often than not, it's a continuation of that healthy momentum. So in this case, I'm still bullish of gold. Nothing has happened in gold that has me thinking that the run is over. If anything, I think it's more likely we see 5,000 in the first half of 2026 because we're consolidating these gains, because we're building some healthier price structure for gold to fall back on if there is a pullback. That's what you want to see. I know it isn't quite as fun for the trading account. Your P&L isn't going to keep going straight up. If gold isn't going straight up and that's your long, fine. But if you want it to go higher over the long run, this is exactly what you want to see. And gold was one of the first commodities I started trading in 2006, and it was so much fun to trade back then. It was fun from like 2006 to basically 2012, 2013. And then it kind of got boring for a long period of time. And it was really only in the last several years that it started to become really fun to trade again. So I'm glad to see gold's lively. It's not a good thing to see for reasons of it's up because there's huge deficit spending. It's up because there's irresponsible policy from central banks. It's up because there's growing economic uncertainty. But hey, we're here to trade the market in front of us. This is a fun vehicle to trade. I'm all about it. I think that for swings, we can see that the gold Ichimoku cloud has been an area of support. So when it pulls back to the cloud, that's usually a rebid zone. And we had one of those opportunities recently in late November. And looking at gold's, I guess you could say, crazy cousin, the white metal we call silver. Some call it the devil's metal. But this is another one where that rebid zone is right at the cloud, right? This has been a pretty easy way to define momentum. And one of the things I said starting off the stream is I like to use momentum to qualify my trades. So if at a glance, you could see you're above the cloud, from that school of technical analysis, that means you're in an uptrend. Testing the top of the cloud and getting rebid, that's confirmation the trend is still intact. Also gives you an easy way to manage your risk, because you can see at a glance how healthy that trend is. So we had one of those opportunities in silver in mid-August. We had another one recently in late November. And we continue to make new all-time highs in silver. One of the things I said in early 2025 was I thought this would be a great year for silver to outperform gold, to really get running, because what happens in precious metals markets, usually gold starts, then we start to see the miners follow on, and then silver and the juniors really start to get excited, and then you have a full-blown precious metals market. That's where we are now. We're still very much in a long-term precious metals bull market. Silver broke out of major resistance when it punched above 48 and held that level closing out October. That was incredibly important to show that we didn't have some kind of double top head fake. Instead, we have massive continuation. We've gone up over $10 from that breakout level, breaking above 48. I think silver could hit $75 an ounce in the first quarter of 2026. The reason I'm more bullish on silver than gold is silver has some catching up to do. Silver is also considered, and I don't like to call it this, but it's sort of like the poor man's gold. But basically, it's cheaper per ounce. It's still a precious metal, albeit more used for industrial use cases. And those industrial use cases are likely to be on the rise, with more demand for renewable energy, for communications, for the build out of a lot of this infrastructure. Silver is the best conductor of electricity on Earth. It has a lot of applications in manufacturing. So that's another driver. It's the US and China that are the biggest consumers of silver, hands down. Now let's take a look at crude oil. I have been bearish of crude for quite a long time because what I'm not seeing is any signs of a real reversal here. The most promising thing we've seen lately is just a higher low that happened in late November. That's great, but at the end of the day, the path of least resistance for this is still lower. You could see it just at a glance. Again, where are we versus the cloud? We're below it. You also had a bearish cloud twist. You can see you have a red cloud here. That's indicating that there's a signal for negative momentum. So I'm not really looking at energy very bullishly yet. If we could punch above the cloud, if we could hold above there on a weekly close, I'd probably give it a second glance. For now, however, I think we're more consolidating. We may have tapered off on the downside momentum. I wouldn't think that oil gets much below 55 without an economic flush out. So we're probably closer to the lows, but we can still grind around this level for longer than one might think. And then finally, we've got Bitcoin. This one is in an area that's very interesting to me. This zone between 80,000 and 86,000, just rounding to make it easier. This is an area of support, and we're starting to make a push above it. I don't like that we're below the 21-day EMA. You can see that's kind of important to Bitcoin. It's rejected there several times on its way down. But I do like seeing that we're getting a bid around this zone. That's a potential area where you could see some strong support come in. The next thing you'd want to see is a decisive break above that 21-day EMA to show that there's been a change in character here. And I've got some things to share for you. First, the folks at Bookmap have some pro trader webinars coming up. some of which have happened, but there's a third, the fourth, and the fifth coming right up for you all. And then also some great deals on a variety of different things at Bookmap. You can use this QR code, or you can visit traderade.com/bookmap. That's traderade.com/bookmap to take advantage of these offers that are running through the end of December. Pretty juicy deals overall. If you've been holding off on getting Bookmap and you've been thinking, boy, I just want to get a really good deal, this is the time to take that into consideration, because these deals are the best ones that I've seen them offer all year. So with all that being said, it is time to dive in to Bookmap. We've got about 3 minutes left till the market open. Just going to take a look around, see if there are any questions. And Charlie says, I have an identical support rectangle on my SPY chart. Guess I'm doing something right. Yeah, absolutely, Charlie. Good work on that. And that's really what it's all about. I mean, look, at the end of the day, technical analysis is both an art and a science. There is evidence that technical analysis is valid and it works. Some things are probably more because we believe they work, like a moving average. You know, there's nothing magical about tracking the average price looking backwards, but because humans believe that they have validity, and because algos are programmed by humans that believe they have validity, they tend to work to some degree. Obviously, your mileage may vary. Different assets trade with different personalities, but I think that if we're able to validate our analysis, if we're able to see price continue to interact with some of these key levels, it behooves us to pay attention to those levels. Hey, Jonathan. Jonathan says, always appreciate you having the stream up. Appreciate you having you tune in, my friend. Thank you. And if you enjoyed the stream, feel free to like, subscribe, share it out there. Always appreciate your support. It's about less than 2 minutes until market open here. S&P futures continuing to flirt with that key pivot level we talked about a little bit earlier in the stream, that 6849.25. NASDAQ futures trading just a bit above it at 25,510 versus 25,445 for the pivot. So I'd really like to see them both build some acceptance above that pivot, but I am encouraged seeing the NASDAQ at least leading. And over in the crypto space, there's a bid that's back. Bitcoin trading at 88,000 after a rout over the weekend. So that's a bit of a risk-on appetite that we can take into consideration as we get closer to the market open. And not a lot of economic events happening today. We had some Eurozone unemployment data and CPI over there. Unemployment came in higher. Or no, I'm sorry. Yeah, unemployment came in higher. CPI also came in higher. So not the best data from the European Union. Then we've got the Fed's Bowman testifying in front of the House and a Trump cabinet meeting coming up at 10 a.m. and 11:30 a.m. respectively. And markets are opening here. We can also see yesterday started off with some pretty bullish flow. I talked about that a little bit on my feed, but then ultimately we had bearish flow take the lead into the later part of the session and pull the market lower. So it's a bit of a reversal. That put wall that was built is a somewhat formidable area of support if we do get pulled lower. And for those that may not be familiar, a put wall is essentially an area where there's a very large amount of negative gamma exposure that can act as support. And if you think about it, it kind of makes sense. If you're long puts and the price gets closer to your strike, you're more likely to exercise. You're more likely to take profit. You're more likely to do what you need to do. And that means you're going to have some liquidity positive action coming through the market as market makers can flatten out some of that delta hedging. Similar with a call wall. If you're long calls and you're getting up to that strike, you're more likely to sell those calls, which is liquidity negative. So these are self-reinforcing levels based on positioning and how dealers react when that positioning may lighten up as well. Loki says, I remember you made a great call on Google several months ago, but I want to know going forward, is that TPU a better choice than Blackwell? That's a great question. So yeah, I did talk about, I thought Google had a ton of potential back in June. I've been following the TPU story, also following the momentum on the stock. Put a call out there around 175 to long Google, and it's just exploded. It's almost doubled since then, which is incredible for a company of that size. I think it's now larger than Microsoft and almost as big as Apple. Nevertheless, the Google story is one of a company that has AI in its DNA. This is not your typical, hyperscaler that's just sort of buying GPUs and building out cloud capacity they lease out, or maybe fooling around with creating some of their own models. Google was the architect of transformer large language models, which is what AI, if we're going to call it that, is built on. And so it's not terribly surprising that they also were able to build specialized chips called tensor processing units, or TPUs, that allowed them to do training and inference with much less cost and much less power. So is the future of AI, or at least generative AI, in chips like Google's TPUs? I think it is increasingly going that direction, and for a variety of reasons. One of the reasons is that at the end of the day, you're already starting to face a pretty big problem with the amount of power that is available. GPUs are extremely power hungry chips, and they're not necessarily optimized for training and inference. They're much more multi-purpose. So it's kind of like using a sledgehammer to drive a tack. It works, but is it the most efficient approach? Versus TPUs are specifically built for inference. And you're seeing other companies build similar chips. Broadcom, Qualcomm, even AMD is likely to get more into this space. And I'm sure NVIDIA will as well. But at the end of the day, specialized chips for AI, I think that is where things are going. Just like we're seeing models become more efficient, we're seeing quantization methods become more efficient without losing precision. We're also seeing the hardware stack become more efficient. So I do believe Google has a durable competitive advantage in the sense that they were first to building LLMs. They were first to building a lot of this TPU technology. And now they're really starting to flex that with Gemini 3 Pro being one of the leaderboard frontier models. So I do think that's something they can continue to lean into, and subsequent iterations of their TPUs are likely to improve. You also have companies like Amazon that are building chips called Trainium. And those are chips that are to do the heavy lifting part, the training, where most of that usage happens, because that's really where you're pulling all the data together. You're creating these probabilistic relationships between the data that they've gathered, and you're creating an inference model, right? Or a large language model. So specialized chips, AI, yes, bullish on that. Not quite as bullish on NVIDIA, because I think they're going to have more competition moving forward. So they really need to get their act together with building customized, specialized chips for AI rather than the more general purpose GPUs. That's my take. Can I speak on my view of high bandwidth memory? Sure. Yeah, I was bullish on Micron too. I actually put something out there earlier this year before it had that big surge. And Micron finally kind of figured out their high bandwidth memory. That was one of the big reasons they got going. And now we have the shortage. RAM prices have doubled or tripled depending on where you're looking. I think that's still an area of opportunity. As long as there is powerful demand for high bandwidth memory, there is going to be a bid under Micron and HK Hynix and a lot of these other companies that are in that space, and ultimately the companies that feed them too. So I think that there are a number of areas in semiconductors I would love to see a correction before wanting to rebid them, but they do have some secular tailwinds as this growth story plays out, especially as there is a supply crunch in high bandwidth memory. And you're going to need high bandwidth memory if you're going to continue to pursue generative AI. Whether you're using TPUs or GPUs or other specialized chips, one thing that remains intact is that high bandwidth memory, because that's the speed at which you train and infer. It's largely governed by memory bandwidth, particularly on the inference side. And getting a nice powerful push higher here. Really still seeing some level of resistance at our pivot. I want to see a break above that pivot and some acceptance built. A reminder for those tuning in recently on ES, that pivot is 6849.25. You're welcome, Loki. Thanks for tuning in. Starting to see that push above the pivot here. Next thing I'd like to see is some range expansion for that 20-minute opening range we're forming now. And then we'll get to see the flows start to come in and get a sense as to what the mood of this market is. But so far, it looks like we're set up for bullish continuation. We've got our canary in the coal mine crypto giving us a sense that risk appetites are coming back today. That's a very good sign, especially for growth and tech. NASDAQ bid up about 0.4%. S&P bid up just over 0.33%. And the Russell 2000 small caps back after a nasty drawdown in November, had a powerful rebound, and the Russell leading the way up 0.75% here. And the amount of volume coming in here is pretty encouraging. I know the open tends to be a pretty busy time of transacting, but I'm looking at the deltas in volume, and the buy side deltas here are pretty darn impressive. Especially seeing it push above a major level of implied resistance like that. Let's see if we can build some more acceptance up here, expand this opening range, and get some bullish flow in. If so, I'd say we have the recipe for a trend day. Looks like we're giving that pivot one more retest here. Let's see if we can use it as support rather than resistance and make a move higher from there. That would also be encouraging. And looking at about a 14 handle opening range so far, I do like to look at the 20-minute opening range. Another thing to mention is Tuesdays have about a 60% chance of a double break. That means you could have an opening range break above and break below, or vice versa. Some reason Tuesdays are more likely to see that type of price action. And that's looking back about 5 years. I don't tend to backtest much further than that, given how fast the market tends to evolve. And indeed, we seem to be balancing out around that pivot level. Let's see if buyers can make a push here. And they just seem to be absent, maybe on strike for a minute, taking a lunch break. I don't know. But they had a great chance to make a push there, and they're kind of fumbling. Seeing that sell side delta volume pick up in a big way here. And we should start to have some of those SPX index options flows coming through in just a few minutes, so I'll be watching those pretty closely. Tend to post those out on my Twitter feed as well, at least once or twice a day. We have that flow updated every minute on our Discord. In fact, that's a key part of the SPX options visualizer. Watching the flow and watching the key gamma exposure levels, which you can see here on the rightmost column. And we do have a lot of support below us here. Key 3 negative, key 1 negative in the put wall. Those are all large areas of negative gamma exposure that are likely to offer support. You can see some confluence between key 3 negative and key 1 negative with the point of control. And so far, sellers are the ones that are more offsides. If you look at the session volume profile here, you can see that bump out in red. All those folks, assuming they were selling to open, are offsides in this move higher. And what that means is they're more likely to get stopped out or at least abandon those trades, which tends to be liquidity positive for the market. And folks, a quick reminder, if you want to get 50-60% off Bookmap, visit traderade.com/bookmap. Scroll down to those special offers. They've got some great sales going on this month. And if you want to check out what we're up to at Traderade, you can use the code Mayhem20 at checkout for our Discord to get 20% off your first billing period. Getting close to the regular trading hours lows here. Wouldn't mind seeing some range expansion lower either. I'd just prefer to see a larger opening range than what we have so far if possible. But 14 handles is not terrible. And we can see some of those flows printing in the visualizer here. The most active strike is the hot call. And that implies ES 6861.75 as an upside target so far. Let's let these flows continue to build, however. This is pretty early yet. But overall, initial read is a bit bullish. NVIDIA's CFO speaking at the UBS conference says most new NVIDIA chips being shipped are adding new data center infrastructure, not replacing the installed base. So that's some more chatter that undermines the idea that companies are not depreciating at the correct rate, which I tend to agree with. I think GPUs do have a longer usable lifespan. The key is whether you're going to want to have any sort of profit margin on renting that GPU time, because the problem with the older generations is they aren't power efficient. And a lot of the companies that are renting GPU time are still struggling with margins. So it's a balance. And we're seeing the hot call roll up, and it's about a 2-to-1 between the two most active calls and the two most active puts. So far, flow is giving us a suggestion that we're poised to move higher. And some of this early flow that we're seeing in the first half hour could be a little bit of the flow that continues from yesterday's drawdown. That is to say, there could still be a fair amount of unfilled sell orders that are getting pushed through this morning. It's one reason I don't really like trading the first 20, 30 minutes, because you just have so many cross currents. I like to see whether a trend takes shape and try to capitalize on that instead. To me, it's lower stress and it's just easier to set it and forget it. You basically set where you think your target's going to be. Typically for me, I'm using the hot call minus a point or a point and a half. And then you set your stop out, and you don't need to sit there and obsessively monitor that trade on a trend day. If you're playing ping pong with a day where the market's consolidating, it's a bit more involved and not necessarily leading to the same kind of profits. And I had meant to throw this ticker up earlier. It slipped my mind. I've been working on this thing to be able to just add a little more value to the stream, run some headlines and so forth. So you'll be seeing that in future streams. You probably see it on some of my other streams, but I had to update the code base for it to run on my system because my system has 6 monitors directly attached to it. So the way that it identifies the screen and places itself at the bottom needed a little extra refining. But finished that yesterday. Was excited to put it out there today, and then for the first, half hour of trading, kind of forgot about it. But there you go. And I wrote this ticker. It's kind of cool. It pulls headlines from a variety of different sources. So in terms of where we are right now, we've formed about a 14 handle opening range. We've got bullish flows overall, but they're starting to balance out a bit here. Now it's about 3K on the 2 most active calls and 3K on the 2 most active puts. So we started off with more bullish flows. Now we're balancing out. We could see the midpoint on screen as well. And it looks like we're about to make a new session low here. So we talked a little earlier about wanting to see building acceptance above that weekly pivot and seeing call flow in excess of put flow to set up a trade, a trend trade higher. We're not getting either of those yet. So there really hasn't been a trade set up. And I like to say some of the best trades that you'll take are the ones you don't make. And what I mean by that is less is more. Don't burn yourself out over trading. Wait for the high probability setups. If they don't come, there's no shame not trading that tape. For me, so far today, I haven't seen a high probability setup. That's probably one of the most important lessons to talk about, to be honest, because I see a lot of trading streams where folks are kind of forcing their trades and they're doing it to, because it's almost like a performance art when you're on that kind of a stream. It sets really bad expectations for the audience because they think they could just pop into the market anytime and there's some kind of trade to be had, and it's more like gambling than actually, setting the probabilities on your side and executing like a sniper. I really think less is more. There are days where I'm not trading. There are other days where I'll take several trades when the setups are there, but I don't feel the need to be having skin in the game unless there's the setup. I don't need the dopamine rush. I don't need the adrenaline. That's not why I trade. I trade to make money and then to invest that money. And that's one of the things that I also like to discuss when you're trading and you have an account and you're building that account, set a threshold. Above that threshold, roll those funds into long-term investments. Stocks, fixed income, real estate, business investments, whatever it is, diversify. Trading should not be the only way that you make money. If you're trying to do this full time, you should have a diversified stream of income and investments. Makes it a lot easier to trade with a clear head too, because there's not that pressure. Oh, I've got to make money every single day trading. And so then you start forcing trades, then you start getting into trouble, and it just turns into a vicious cycle. It also undermines the psychology that leads to consistency. So less is more. Seeing some iceberg buying and selling here. And taking a look back at the flow as it evolves here, we're back leaning a bit bullish. Could see that in the distribution in calls versus puts. The midpoint has disappeared off screen. And we've managed to put in about a 15 handle opening range. So that's about my baseline. That tells us we could have a relatively dynamic trading day. 15 or more handles on S&P as an opening range is kind of my baseline for that. Charlie saying the banner is a cool feature. Thank you. Figured y'all would dig it. It's kind of cool. It gives us a little bit more info. And more color from the NVIDIA CFO. They have a $500 billion in bookings for Blackwell and Rubin AI chips through 2026. And they say that does not include any of the work that they're doing right now on the next part of the agreement with OpenAI. We don't really. So Loki asks thoughts on upcoming economic data. We don't have a ton. I mean, tomorrow we're going to have industrial production, U.S. S&P services, ISM services. So, one thing that happened during the shutdown is BLS was kind of gutted, and the White House even said they're not sure they're going to ever get things back to where they were. I think that's a mixed bag. That is to say, there's an opportunity here to improve how we collect and distribute data. It shouldn't be survey driven, it should be data driven. So I just put that out there as a bit of conjecture. But I think we're going to see an economy that slows. And I think it's going to slow for the next several quarters. The only reason that the economy was growing in the first half of this year and really even in the third quarter was AI spend. That's what pushed us into growth. And so the question starts to become, is all that planned capex for new data centers, new power, new GPU purchases realistic with some of the gains in efficiency we're seeing on the software side in how models are trained and inferred in the models themselves, and then also in the diversification of what chips can be used to build out that ecology, many of which are more power efficient. I think there's a lot of cause for pause. And if anyone pauses the AI capex story, it's likely to be Microsoft, who started talking about that earlier this year and then reversed course. So Microsoft would be the first company I would look towards for signs of AI capex slowing. If it does, that's going to have a pretty big pass-through effect on the economy. But nevertheless, even without that, there's still signs of the economy beginning to slow underneath the surface. It's been a very K-shaped distribution of economic outcomes as well, with the sort of top quintile enjoying the benefits. They're the folks that tend to own assets. And then the bottom four quintiles really not having a good time overall. Costs have gone up much more than wages. A lot of people are struggling to make ends meet. Black Friday sales, even though on nominal terms they set a new record, when you drill down, a lot of it had to do with tariffs and other kinds of inflation. A lot of people really struggled, and when they did do purchasing, they tend to do it on credit cards rather than buying it, and paying it down. So I do think the lower four quintiles of consumers are not doing quite as well. The top quintile is doing just fine. Probably never been doing better. But that does eventually have a bit of a drag effect on economic growth. So I think that's something we'll see in the fourth quarter, first quarter, and possibly even second quarter of next year. I also think that's one reason that the White House is really pushing to have rates cut more, to put in a new Fed chair that's more sympathetic with their view. Because if you look at the economic data, especially the stuff that they can see, that isn't necessarily coming through the official agencies, but it's more through looking at what's happening at the major banks, how you're starting to see some of the lower tier borrowers struggle more on their auto debt, their credit card debt, their student loans, and otherwise. The struggle is real for those lower four quintiles, and that will have a drag effect. So if the AI capex narrative starts to become unhinged, that's really where the economy has the potential for greater weakness. So as we wrap up here, we're pushing back towards the top of the range and above my pivot. We've got signs of call flow starting to build. The hot call and warm call 8 and 7,000 versus the hot and warm put 7 and 5,000. So still looking like we want to tag that hot call here. You can see an offer building with some confluence to that hot call. And what I'd like to see is us push above the top of this opening range, tag that hot call, consolidate to suggest we're building acceptance above this opening range, and then see that hot call roll higher probably to where the warm call is now. So if we zoom out, you can see that around 68.86. That would be my dream scenario. We'll see if that plays out. But overall, we do still have the ingredients for a potential trend day higher here. We just need to let them take shape. So we're getting above that pivot around 68.49 and change. We're heading towards that hot call. We're breaking above the 20-minute opening range. Those are the sort of key ingredients. Then we need to build some acceptance, and then the path of least resistance really is higher. Just keep in the back of your head, however, that double break Tuesday. It can still have a 60% chance of a double break. So, folks, thank you so much for tuning in to this week's episode of Back to the Futures with me, Markets and Mayhem. If you want to learn more about my work, visit Traderade.com. If you want to take advantage of getting up to 20% off of Traderade for your first billing period, use the code Mayhem20 at checkout. And to get 50-60% off Bookmap, visit Traderade.com/bookmap. I'll be back next week at 9 a.m. Eastern. I'll catch y'all then. Have a great week ahead.